this month we saw values increase by 1% over the month, but you only actually saw increases in Sydney, Melbourne and Brisbane. So we're not seeing broad-based growth in the housing market. Of course, you always get a little bit of noise month to month, but even if you look over the last 3 months, you've only seen growth in Sydney, Melbourne, Brisbane and Adelaide. So it's not a case that growth is happening right across the board. It's only happening in select areas, and certainly Sydney continues to stand out. Values are up 3.9% over the last 3 months, so it's growing at more than 1% each month. Obviously, the mining areas are really struggling at the moment. Iron ore prices are off massively, and that's hurting a lot of those areas. Also, coal prices are down, which is hurting a lot of the mining areas. In terms of the capital cities, we've really seen a reversal of fortunes for the Perth market. Sort of 12, 18 months ago, it was growing at about 10% on an annualised basis. Only around 3% growth over the last 12 months. And as you said, Canberra as well. 0.9% growth in values over the last 12 months, really slowing down. I think obviously Perth is linked to what's happening in the resources sector. Canberra is probably linked to the job losses that are looming in the public sector. I don't think too many of them have gone through yet, but I think given that's coming, a lot of people are just sitting on their hands in Canberra and not making a move. I think what you're finding at the moment, we know first home buyers aren't very active. So what we're getting is all these new inner city units in particular coming online, and that adds to the rental supply. So over the last year, rents have increased by 1.8% across the combined capital cities, which is actually the slowest annual rate of rental growth since August 2003. So we're not seeing much in the way of rental growth at the moment. Got all this new supply coming online. And I certainly think in terms of oversupply, I don't really think that Sydney's at too much of a risk of oversupply, purely because it's had the largest deficiency of supply over the last 10 or 15 years. But if we look in Melbourne and if we look in Brisbane, we're seeing pretty much the highest level of dwelling approvals for units we've ever seen at the moment. So yes, I think there's more demand for units, but I do wonder, are we approving too many? Are we, is there going to be enough demand for all this stock that's being approved? Obviously, a lot of it's getting enough pre-sales and coming out of the ground now, but there's still a really big pipeline that hasn't hit the market yet. Possibly. I mean, we never really know if there's a bubble, when there's a bubble, until a bubble actually bursts. I think they need to be very cautious, and I also think the fact that these units are typically owned by investors is maybe another cause for concern, because if you look at where interest rates are at the moment, 2.5% cash rate, if you've got your money sitting in the bank, you're not getting any return on your money. So people are looking for returns. They're moving into the housing market because you're getting some capital growth, but that capital growth won't be there forever. So what then happens when we're not seeing capital growth in the housing market? Will those investors stay, wait it out, or will they leave and maybe go into equities or go into some other more liquid asset class? I think that's the great unknown. But obviously, if you saw a lot of investors exiting the market at once, particularly when they're very focused in those inner city unit markets, it could put some downwards pressure on prices. As you said, the market is cooling. We've seen 8.9% growth over the last 12 months, peaked at about 11.7% in April of this year. So the rate of growth is slowing, but as we showed, Sydney's still very strong, 3.9% growth over the last 3 months rather. I think the Reserve Bank has flagged macroprudential tools. If anything, I think that might encourage more investors to try and jump into the market now before any rules change. Obviously, they've sort of highlighted that they will make banks hold more capital against investor mortgages. So that theoretically acts as a disincentive for them to lend to investors. So the savvy investors will know this and potentially be looking to enter into the market now. Our view is that interest rates are going to be on hold still for some time, but there has been a little bit of a talk that there could be a rate cut, 25 basis points, and I don't think that they would do it until such time as they have these macroprudential tools in place, but you never know.